I can see the numbers going down and I can see where the money's actually going. That's a stablecoin transaction. That's bridge. A stablecoin is different. You either can get on board or get run over.
What really should change inside of a bank to really grow and kind of capture the opportunity?
It's going to take them months to get there. Months. My guess is about half of them will disappear over the next 10 years, and that they'll all merge.
What should the CEO of a community bank or even a regional bank be thinking?
Views are personal, not investment advice.
This is Money Code. It's a show where we decode stablecoins and programmable money. I'm Chuk Okpalugo.
And I'm Parekh. And today we're joined by Chris Dean, CEO and co-founder of Treasury Prime. Excited to have you on, Chris. Well, let's jump in. Chris, you have a really interesting point of view, and we were talking about this a little earlier as well. But is the common perception that banks are slow to innovate? Is that true? And I'm curious from your point of view, like what is the root cause of that? Is it regulation? Is it tech debt? Is it architecture? Or is there something else? Like, overall, curious to get your point of view, just to kick things off as well.
Sure, for sure. Hi, thanks for having me. Banks are slow to innovate. This is true, especially at least in the things that we think of as innovation. For like the latest commercial checking account, sure, they can give it a new name and give you a different interest rate and stuff like that. But generally, it's not. It's a cultural thing. Is that the person who joins a bank is not someone who likes risk. They're the opposite of that. And any change is risk, any change. And so they have to be convinced that change is good. And in general, I think banks are really good at two things. They're good at managing risk, like they write a lot of loans and they have to get their money back. And they're also good at relationships with their important clients. Like I have a banker, I could text her right now and she would respond in 5 or 10 minutes. She's great. She's really high touch, wonderful. But none of that goes to they're good at making software products or releasing cool new things. They have to be convinced that it's not going to fail. And that takes a long time, especially when I can't convince them it's not going to fail. Oh, hey, you want to do some stablecoin thing? I got the thing to do. And they're like, convince me that this isn't money laundering. I'm like, okay, we could do that because it's not, but it's going to take them months to get there, months. And then they'll be, okay, now I'm ready to start. Okay, great. I've already done this. I've already completed 3 other projects in that meantime.
Right. And it's so interesting. And I think the cultural aspect is probably understated. There's a certain approach to banking and risk management. And I think that probably does underlie a lot of the decision making. Are there certain banks that move faster than others? Are there some special cases? Are there ways that we can think through and say, okay, well, actually the culture here is different? Or are there kind of structural things that just make it hard for banks to innovate?
Mostly hard. It's a difference of degree, not of kind, if you're following me. There's not a bank out there, unless it's there's actually, okay, there's a couple. There's Airbor and Column are maybe a little different. Maybe. But most of them are just they're more accepting of new ideas and less accepting of new ideas. And traditionally, the larger banks are less accepting because they're in a great position. Banks are in many ways the ultimate capitalist. Bankers, they love capitalism. Me too, so great. And the challenge here is that they're in such a good position where they're making so much money. They're like, why would I mess this up by taking this risky thing? And you're like, there's a pile of money over here you could have. And they're like, yeah, but I have a bigger pile sitting right in front of me. I'm just gonna keep working on that. The banks generally that innovate faster are ones where there is a leader there who wants change. And generally the ones that do this well are smaller banks. So think what in the US we call community banks. So between 1 billion, 10 billion in assets, deposits, either one. And those are banks that have, 100, 200 people in them, and a single leader who's loud and forceful can really make the bank change. You get much bigger than that. You get to the banks with 1,000 people in it. It's just hard to get 1,000 people to change basically who they are. One of my favorites is Grasshopper Bank, which just got purchased the other day. They have, the CEO there. It's Mike Butler is his name. Mike is like that. He's a forceful person. He wants to innovate, and that's why it works. We have other banks we have a bank, Academy Bank. We have Bangor Bank. We have all these banks, but they all have the same thing. They're smaller banks who have a leader who really wants things to change. They're all the same. We have bigger banks too, but they only want the sure bets. Like we have US Bank, for example, but they only want ones that are absolutely fantastic. And, it's a risk reward thing. They take the fintechs that are already awesome. I'm like, well, they're not going to get like 10 times more awesome after you get them. But I don't know, pick the Academy Bank. Well, they'll take someone on early. They'll see them do $100,000 the first year. It's like nothing, right? But in a couple of years, they're doing 10 million. And like, oh, that's good, right?
Right. And this is a really important moment for banks, especially as the Genius Act has been passed, last year. The technology layer that underlies finance is changing. And some would say the financial infrastructure is moving to a new kind of layer or a new piece of infrastructure. And so you sit, Treasury Prime sits kind of in the middle of the fintechs who are looking to get access to the services and the jobs to be done that banks provide, and the banks themselves who have the regulatory or technology underlying that enables these things, but aren't necessarily the ones who are meeting the customers. Maybe it's helpful to just kind of set the scene here for what Treasury Prime does today, who your customers are, and what jobs are the fintechs coming to you to help solve with banks on the back end?
Yeah, sure. Treasury Prime is broadly put, a banking as a service company, right? What we do is we write software. We are a software company that writes software so that banks can enable a fintech line of business. Our customer is the bank. Our customer is not the fintech. So this is often a source of not confusion, but going back and forth for the first couple of minutes. We're like, a fintech will come to us and say, we need a bank to do their thing because we need, money to be stored and stable. If you want to ignore stablecoin for a second, the only way to actually store money in the US fiat money is to have a bank charter. And so you need to have someone who has a bank charter. And they come to me and say, what do you got? And I'm like, I have a list of people who work with me. There's a whole matchmaking process. It's like, I feel like I'm setting people up for dates all the time. Like, I'll help you out. I'll help you plan the first date, but it's on you, buddy, if you want to go out and have fun. And that's what Treasury Prime does. We have a whole suite of software so that banks can run their fintech relationships, and the banks love it. They use it to manage it. They make enormous profits. They get gigantic deposits. Oh my gosh. But the thing that the fintech gets is they get a bank and they get a modern interface to the bank. Bank systems are archaic and, need I say, terrible. But what we try to do is wrap that whole thing in a shiny layer so it looks, all the banks look kind of the same. There's an API. It says, I want to know my balance. There's an API. It's the same everywhere. I want to send a wire. It's the same everywhere. I want to issue a card or, God love me, a paper check. It's all the same everywhere. So that's what Treasury Prime does. We write software so the fintechs can work technically, and then so the banks can run it financially.
And I thought that was really interesting. You said the banks are your customers. And so they, as you mentioned, want to unlock a fintech line of business under their terms. And so they'll have particular constraints and particular types of products that they want to release. But the fintechs will come and ask for a certain set of things. And if they are provided, great. If they're not, they're going to go elsewhere. And so I would love to get your opinion on, maybe we can start by just kind of going through the things that fintechs are looking for at the moment, which, as you mentioned, today, if you want to hold dollars, you've got to be a bank. And then you mentioned credit as well, and other things, and potentially how that changes when you hinted at it earlier, when there's a new way of doing that.
Yeah, for sure. And I agree with you. You're saying, or maybe applying before, that Stablecoin gives a new layer of infrastructure that you can innovate on top of, which is different than the current banking layer. And that's interesting. Banks don't know how to think about that, but to me, it's interesting. Generally, when fintechs come, they fall in one of three buckets. They want deposits operations, that is, they want to put money somewhere and then send money out after it's been sitting there. A neobank is a classic example of that. Like, I just want to be a bank, but I don't want to get a charter. And there's lots of those. Mercury is a big one. We have one that's great. I mean, it's called Meow, which is possibly the best name for a fintech I've ever heard. Meow, and they have a great banking treasury management product. That's the deposit thing. Another one that people do is credit, right? Where they want to offer credit lines or do some sort of lending. This is trickier because there's all sorts of rules around lending, especially if you start to do it to people. You don't want to be unfair, and there's lots of laws about being unfair. And the last one is payments. And payments are just like, I want to send and receive money. That's it. I don't really want to store it. I just want to move it around. Lots of people like this. This is basically Stripe is a payments company, for example. People don't know who that is. We have some of each one of those, but by far 80% of them are the deposit side. We have one of every kind. The payment ones, I guess we have more than 20% payments. That's true, but the volumes they do are so small compared to the deposit people. Just we'll do. I don't know what we'll do here. What do we do? 120, 130 billion dollars a year in movement. So let's just round that down to say it's 10 billion a month ish. At the plate right now. The normal payments folks are doing some tiny amount of that, like 2 or 3%. So it's just small. And interestingly enough, stablecoin folks do about 1% of our volume, less than 1%, but I think they'll get to 1% in 3 or 4 months. So that's good.
Yeah, I mean, it's super interesting. I mean, you have such an interesting point of view, but at the same time, I was at Visa for a long time, so I worked with a lot of these banks, and I'm not gonna lie, there was times where I was becoming really jaded, working with them and talking to them. But you've obviously managed to help these folks innovate and create better layers for fintechs. I guess maybe if you can describe just what was the analog, what's the pre-Treasury Prime tech stack look like, and then what is you've always talked about the different pieces that you've added, but when you go to a bank, what does that pull to be I need to go work with Treasury Prime to upgrade our stack?
Yeah, it's interesting. It rarely starts there. I mean, I'm with you. I'm a tech guy, right? And I'm like, you should start, but that's not where the banks start. They start usually with it's usually the CEO, not always, but usually the CEO, who realizes that something is changing in the economic environment. So they'll be, I'm US all the time, and there'll be pick somewhere. We have a bank in St. Louis. It's a good bank. It's $2-3 billion in assets, really well run, really efficient. Love those guys. They're in St. Louis, Missouri, right? It's fine, right? But they have pressure from the national banks. That's the Chases, the US, everybody coming into their region and slowly taking their deposits and slowly taking their lending. And then they have the regionals. In this case, is Key and Fifth Third are the ones they see, which are big Midwest banks. They're not as big as JP Morgan, but they're big-ish, and they're starting to come into town and steal their deposits. And this bank, which is I don't know how many people work there, 250 people. They're slowly seeing their business not grow as fast, and the CEO will look at that and go, well, dang, soon I'll be growing negative, and I don't want that. So what other options do I have? A fintech partnership gives them something that they don't have, an ability to innovate quickly, try different markets out, and also reach a national audience. And that's probably the most important thing, and international audience. But this particular bank I'm thinking of does a lot of business in their particular region. They don't do anything in California. I'm in California, right? California's a big market. Why not? Well, by partnering with fintechs, they all of a sudden can reach all of those places. And that's where they start. They say, I need to do something to counter the threat of the banks that are encroaching my area. And I come to them. I don't say I'm selling them a cool API that everybody loves, and it is cool, and okay, almost everybody loves it. And what I sell them is a line of business. I say, you have to do some investment. You'll have to like hire some people, but you can make a whole new revenue stream from these fintechs. And if you're a good partner, they'll stay with you and grow with you. And if you're a bad partner, they'll leave. And they all, 100% of them say, I will be a good partner. They're not always a good partner, but mostly they are. And that works. They make a lot of money from this. And you can tell that for a lot of these banks, which are that size, this is a path for growth as opposed to whatever they're doing now.
How do stablecoins play a role there? On the one hand, there's a new set of products that fintechs can potentially use, but need the banking layer. And so you're saying potentially to the bank, hey, the fintechs want this thing. You want to grow your business, right? Well, enable this thing through me. Yes, you'll need to maybe hire an extra person or so, but you'll hit the goal that you laid out, which is defend against the regionals and the GSIBs and grow this line of business. At the same time, there's a lot, and we've seen a lot of chatter from all sides about the risk of stablecoins to deposits. And so I'm sure that kind of changes the calculus in their heads a bit. How do you see that conversation playing out with the customers that you have?
I have this conversation multiple times a week with banks, some like our banks, some, banks who just are, they're fintech curious, they're not there yet, but they're fintech curious. They don't know what the heck to do. They're terrified of losing their deposits because, it's the way banking, it's a fractional banking system, right? It's not like all my money's sitting in a big pile in some safe somewhere and I'm rolling around in it. No, they loan it out. And the cost of capital is going to go up. The loans are going to become more expensive if they're not getting pretty good deposits, right? They're getting deposits from somebody, they'll give them, pick a number, 1%, 0.5% interest, and like 50 bips is okay, I guess, but maybe I'm with you, but they're going to lend that out at, 700 bips, right? So that's their margin. And if they all of a sudden they have to go buy money somewhere else, they're terrified that their cost of lending is going to go way up. So they all want to know what to do. And mostly they don't know what to do is the short answer. There are people who are doing, consortiums where we're going to mint our own coin, and where I know still like a dozen of these people. That Texas one comes up all the time. And I'm like, cool, this is your way you're going to stop the money from going to treasuries and BNY, because most of the money's in treasuries and a BNY right now, right? And I don't know how that's going to work. Then there's people who are just like, I don't know what to do, but I got to do something, so I'm going to do just payments. I'll do pay in and pay out. That's it. And that's what Treasury Prime mostly does. For stablecoin, that's what we do. We do pay in and pay out.
And what do you typically tell them as you're going through these options and thinking about how they should be thinking about it? Like, what's your typical advice?
I tell them stablecoin's different than the other crypto things they've thought about before. It's certainly, and it's partly in the name, like it is more stable than, pick something, Bitcoin. That's the only one they all know. And Bitcoin is it's a legit investment vehicle. And they look at that and go, okay, well, I don't care. I'm using cash, so whatever. And they're worried about the volatility of their crypto assets. I'm like, stablecoin doesn't have any of that, right? It's just a different thing. You can store money there for sure, but not in the same, it's not an investment in the way that I'm hoping that it goes up or down. It's going to sit there. I might put my money there because most of my fiat currency is in a highly volatile, non-US currency, but that's a different thing. So I talk to them and say, like, look, this is the future. Like, stablecoin is different. You either can get on board or get run over. And I don't say run over, but that's what I mean. And you have to figure out what you're going to do. And I'll tell you, at every one of your banks, you have a group of people who want to move money around in stablecoin. You just do. And I know that because I can see the numbers going down and I can see where the money's actually going. And I'm like, yeah, that's a stablecoin transaction because I know what's going on here. That's bridge. And so your people are using it already. So you can either let bridge and lead and whoever else do that, or you can get on board. That's what I say to them. And that actually resonates because they're like, oh, it's like a payment rail. Like, yes, it's like wires. It's like ACH. It's like FedNow. It's like RTP. It's like no, it's much more expensive actually, but then, oh, for sure. Oh, for sure. Like, how much does an ACH cost? Like 2 cents, 3 cents? How much does a stablecoin transaction? We're talking bips here, right? So it's much more expensive, much more expensive.
Yeah, especially from the orchestration companies as well. You're painting a really interesting picture here, Chris, where it's like, on one hand, you have like the multinational, large JP Morgans of the world, like eating up deposits, the loan books and all these sorts of things from like these community banks. And on the other hand, you're saying, well, there's like these fintech folks, and then there's like this whole stablecoin thing that's now come out of nowhere as well. And so you've got this really interesting conundrum as a community bank or maybe a super regional bank where they're kind of cornered on a bunch of different vectors, and they kind of have to make a decision as well. I guess like what really should change, what change inside of a bank to really grow and kind of capture the opportunity. And I guess like, we've talked about deposits being like the lifeblood for some of these banks. Yes, you can go compete and like, have a fintech with a national partner, but there's only also so many of these fintechs. You kind of have to change the muscle of the organization as well to do go to market and then, compliantly also process these fintechs also. But curious, like some of the changes that you've seen, like once they implement Treasury Prime, that culturally, kind of what we talked about in the very beginning, kind of changes and helps a bank even grow in this new world that we're in.
Yeah, for sure. It depends on the bank, not surprisingly, right? That people are different, but generally, like we led with, banks are slow. They're slow as whatever. They're slow. Like your Visa days, I bet that was like part of the problem, right? You're like, can you do this? They're like, yes. I'll have another meeting about it in a month, and then we'll think about starting a month from that. And I'm like,
it's like pulling teeth.
It's like pulling teeth. It's just the worst. But you got to realize they're doing that because they are managing the risk. That's what they think. They don't want to do something that is risky, that they're going to lose money at. They're very, very careful. So generally what happens is a bank will turn on Treasury Prime. We'll help them find a fintech. We held them by the hand. We closed their first couple fintechs. There'll be a lot of conundrum. There'll be a lot of hand holding to like that first one, that first account that's open. It's such a big deal. And they will, have almost a religious moment after like a month from that when they go, wait, this is actually working and making money. It's not making a lot of money then, but it's making money. And then one of two things happen. Either they like slowly, and this usually takes like 9 months or something like that, they will say, great, let's add a lot more fintechs. And for them, a lot more is from 2 to like 10. Oh my God, 10, so many. And other people will go like, oh, this is making money, but I still am scared of it. So I'm not going to turn off customers. I'm only going to add 1 or 2. And those banks, most of them, they have a fine sideline of business, but it's just a sideline. And that doesn't change the character of the bank. There's like 3 or 4 people running that business in the bank, and that works out fine. But the ones that really dig in, the ones that really work, it does change kind of the whole attitude of the bank for how they deal with technology and things. And very quickly, they outpace what the fintechs do. And they're starting to think about, how can I do more things? And they actually start to go out and look for early stage fintechs who are doing things that they couldn't do before. Like one of our banks thinks there is a solid business if you provide lines of credit to investors. They really think there is, and there isn't a fintech they believe that is doing that correctly. And so they're actively looking for like someone to do that. And that's interesting. But it is 2 different people. One is like, a little worried. I like it, but it's not my main thing. And others are like, they have the religious awakening moment. Like, oh no, I can play on a world stage all of a sudden. And they like that.
You mentioned one of the levers being the data that you see of where the money's actually going, and that making people wake up. And then I suppose there's also examples of other banks doing these things and being successful as another kind of anchor to look at. Now, with all your experience, could you paint a picture for where you see the shape of the US banking landscape going? We have, on the one hand, on the one side, the large banks getting bigger and more profitable, and then using that, and then forming consortiums and their own payment networks that they charge you to be a part of, but they work and they're highly adopted from one side. And then you mentioned regionals earlier, versus also the newcomers on the block, the de novo banks that are starting from scratch and building their technology today, like Erebor you mentioned earlier as well, and I'm sure there'll be more. So how does that change the landscape?
It's interesting. In the U.S., we have a different administration than we had a minute ago, and they have a very different attitude towards regulation. And I always say it like this. What number are we at now? 33, 34. You have 34 months to figure this out and be successful, because if there's another administration change in the U.S., they will not think what the current one thinks. So what I think is happening, I think there's going to be a handful of de novos that start up, whether that's Erebor, which is just A+, or Column, which kind of managed their way in the last one, or a couple others I know, but I'm not supposed to say, and you probably know too, and same ones, but we're not supposed to say. Those are going to be interesting. Generally, those will work for their specialized worlds, but they're not going to be a lot of those. They're going to be a handful, like a half a dozen of them, is my guess. And then you have on the other side, you have a lot of fintechs believing that their margin will be improved if they get a de novo charter themselves. Like Affirm is an example of that. They'll get an ILC in Utah, Industrial Loan Corporation, which is a kind of bank, and they will that will increase their margins. I think that's an open question, and I don't know if that will work. And it's not that they don't know how to run it. They'll learn that it's expensive to run a bank, and it doesn't necessarily improve their margins. It might, but not necessarily. SoFi owns a bank, right? It obviously hasn't made them 100 times more valuable. It's still a good bank. I like them, but it's different. And then you have all what I would call the regular banks. Most of the banks are not GSIBs. There's only a few of those. We have, if you count credit unions, there's, let's say, pick a number, I don't know, almost 9,000. Let's go with 8,500 banks in the U.S. for credit unions. My guess is about half of them will disappear over the next 10 years, and that they'll all merge. But that still leaves thousands of banks in the U.S. And what I think what will happen is some of the banks, maybe 10% of those, will do fintech partnerships, and that will be one of their main businesses. They'll have a wholesale business, they just might have a real estate, lending business. They'll have a fintech business also, and those will be good. And it'll be up to the fintechs to find a good partner and the banks to help the fintechs grow.
Can you just break down for us quickly?
Yeah.
Why is it expensive to run a bank? And the reason I asked that question is just because AI is changing everything so much, from compliance to processes to workflows, that I'm convinced, with little evidence, except for Erebor are doing really well. But I'm convinced that if you break all these things down, put the relationships to one side and the hard work it is to maintain a relationship with the regulator, the cost to run a bank is going to come down. And so the folks who are starting banks today are going to be in a better position than the folks who are acquiring banks today to run, because they have legacy things to change. Is that the right way to think about this?
I think that's probably true, but you got to remember that banks are slower just as an industry, and it's because they're highly regulated. Cast your mind back to 1 million years ago. The internet came out of nowhere, and people laughed at it, and then Amazon's dumb because who wants to do that, and all this thing happened. But then the internet won, right? And everyone, who doesn't use the internet, right? It all won. I can tell you, it took banks a long time to actually become citizens of the net. It took them a long time. It's in my mind, it's a recent phenomenon that the online banking systems are any good. They used to be just the worst. Most of them are still, small banks, if you probably don't interact with them, they're awful. So banks are slower to adopt. So although I'm with you, Chuk, that AI is that's going to change how businesses just run, including banks. And it's going to change the cost of doing all these things. That'll happen. It'll just be slower on banks because the regulators will ask questions that only people will be allowed to answer. And why is that? Because they're regulators and they have a lot of power. And I like the regulators, but it's not like a job you go to because you love change and innovation. It's a job you start with because it's a cool civil service job. It's a lifetime career. That's great. And you have a duty to protect the economy of the U.S. And most of them are really into that. They really believe that. Like, thank you. Good. I don't want the banks failing either. So that's great. But it does mean they're going to be very cautious in what they let the banks do.
Yeah, I mean, I think on that point, it's really interesting because if you, there's like a really fun chart out there of like the number of new bank charters issued, over the last like many decades or so, and you can see like there's many, and then it quickly just declines down, and then obviously with
right now it's up
recent,
though, right at this moment, yeah.
Well,
Sorry.
and that's actually what I wanted to mention is like we're starting to see a new uptick now where it seems like the OCC especially is like wanting to position themselves as a new innovative regulatory body, and they're obviously issuing new OCC charters. But there's like a couple different like elements that we've talked about. It's like, okay, well, if we have AI that decreases the cost of building software, maybe these workflows, you have regulators like the OCC that are maybe more forthcoming and maybe more like progressive now. They want to start to issue more of these charters. And so if you're an Erebor or you're some of these new banks, you don't have to inherit like any of the existing bank core requirements, but you can build like a fundamental new stack. Maybe it's Treasury Prime, powered, or maybe it's something else. But I'm just curious to see like your view on that too.
Sure. Be careful. I'm not saying anything definitive here, so like be careful of that. But it is not a given that a regulator will allow you to use a the core they're not familiar with, the one that you wrote, and especially one that you wrote yourself. It is not a given thing. They might just say, no. Why aren't you using FIS or Fiserv or Jack Henry? Those work. We're convinced that if you use those, you won't lose money. How do I know there's not bugs in the one you wrote that is going to make you lose all the money? And the answer is, you don't know, but it's not going to. That's a hard conversation to have with some regulators. If you are in a good position with the regulators, maybe you have a buddy who's president, you can get around some of these, but this is not true of most people. I know that a lot of the de novos they're using existing cores. They're trying to think of ones they can buy that they can then wrap with, with software and AI and all that. But the central thing, the core, is still like that. Like, it's hard. We interact with cores all the time. I think we do almost more than anybody, and I think we're tied with somebody, and they're legit bad, right? They're just like such a pain to work with. And why don't they switch to something new? Because the regulators don't want them to.
For those who don't know what a core is, can you just explain? Is it just a database, or is it a special database with like bells and whistles that the regulators know how it works? Like, maybe you could explain what makes it so hard to replace.
Yeah, it's not a hard technical problem. It's a big technical problem. It's not. A core is just the ledger that keeps track of everyone's money. So if I have $1 and you have $2, then there'll be a line in a database somewhere that says I have $1 and you have $2. And if I spend 50 cents, that will go and like that will be recorded somewhere. So there's transaction history. It's a ledger. There's different ways to do it. I mean, this is not, it's an involved problem. It's not a hard problem. You don't want to get it wrong. You don't want to add numbers incorrectly. You don't want to have your corruption happen. You don't want to say the wrong thing. That's essentially what it is. But there's 100 bells and whistles around it, from just reporting tools to permissioning tools, so that, I might have $1 or 50 cents now, but once you check out $2, like, I don't want to be able to steal his money, right? So there has to be protection around that. And generally there's account numbers, there's ways of sending money around, ACH and wires, are the big ones. You can get a check if you want. You can attach debit cards to this. You can call up customer service and say, like, I want to change my address because I need you to send me tax statements. There's all that stuff. It's just a big problem. None of these things are hard. Maintaining an address is not a hard problem. Making a bank statement is not a hard problem. Doing taxes, turns out, is also not a hard problem. But there's it's a death of 1,000 cuts. There's so many of these that the big software vendors have done them all. And so when a new bank comes, they use that. And when the regulators look around, they go, how come 99.9% use one of these, I know it is like 7 vendors, and you want to do something different. What makes you so special? And they're like, well, they're all bad. I want something good. Like, that's not an effective argument, it turns out.
Right. And it's so true, especially as you mentioned earlier, the risk aversion and the proof, the burden of proof being on the other side of prove to me that this is going to work. It's like, well, I actually don't have hundreds of years of history across hundreds of thousands of banks. So therefore I can't prove to you, but if you let me, and the regulators like, well, no, just go use one of these other things. So that makes a lot of sense and is kind of a structural element in there. But I think what's interesting is because of that and the constraints, you then have this banking as a service layer, which obviously you're a part of and you help facilitate in certain ways. And that means there's another layer, there's another ledger that's keeping track of balances in a different way. And sometimes those things don't fully track and reconcile with the underlying ledger. And then you get issues like synapse and so on. And you have, I think, the best insight into how all that works. I think the question that people are thinking is, aren't blockchains ledgers? Don't they solve this?
Oh, yeah.
It doesn't need to be a public one, or maybe it should be, but isn't there a way to connect all this together and stop, signups from happening in the future?
Yeah, for sure. I mean, most of the existing cores are mutable databases where they store, there's a number that changes, and then there's a history audit trail and transaction history of that. Some of them are immutable tables, which is essentially what, it's at least, I don't know, half, 3/4 of what a blockchain is, right? You can't actually change a number. You can add a number. You can say like, I move money from here to there. And so that changed it, but you can always look at the history and see where you were. It's immutable like that. Most blockchains have some authority component to them. I mean, we all know this, right? Like you can do the simple voting one. Like most people have to agree that this is the new reality. Banks don't do that. The authority is them. They make a decision. It's arbitrary. It's usually correct, but they can say to Raj, like, sorry, I know you thought you had $1,000. You only have $900. And they're like, but, and they're like, they'll have a long explanation. That's probably right, but it's different than having it on the blockchain, right? The banks have reconciliation problems. When you say bank grade security, it's not very secure. When you say things like, oh, bank transaction ability, it's not very good. But what is true is that they are very good at reconciling, like you were talking about. And when you do reconciliation, you need to balance all these numbers. And it's easier if you can make arbitrary changes, because the system is not in balance all the time. The system is in balance periodically. Hopefully every minute. It's never that good. Hopefully every hour. I think ours is a good every hour, but barely. And most banks are every day or sometimes every week. We famously had a competitor who's now, out of business, who reconciled once a month. And I'm like, wow, what if you're wrong? It's like a month old, man. Anyway, that's a problem. Sorry about it.
Yeah, no, I mean, you're painting such an interesting picture here because of all the different layers here. And, to your point around the blockchains itself, it's like, yes, it's a decentralized ledger. There's obviously a consensus mechanism to ensure all these transactions are valid, but there's all this downstream stuff that still needs to get done. There's reporting, there's like the reconciliation between like the internal systems as well. So it's like, yes, we have this really interesting blockchain component to it, but there's all this stuff around like audits and regulatory reviews and all these different obligations that banks have as well that still needs to get done in some capacity. And we can't just say, go to the blockchain. Like you have to build these systems out as well.
Yeah, for sure. And I think that when I talk to the bankers, they're not worried about stablecoin payments so much, because they look at that like 90+% of the payments that happen are international in the year, right? Like when I see money going in and out, it's all to move US dollars out of the US. And like, great, that's a good use case. And they understand that. And they're like, yeah, I'm not worried about that except for money laundering. And then you have to have a story that, you're not funding anyone bad. But you're not. So I'm not really worried about that. The thing that they do worry about, though, is when stablecoins start to be a source of deposits and they're competing directly with the banks. And they're worried about that for the obvious reason that's like kills their business. So of course they selfishly don't want that, which is, I understand that. But also some of them, the smarter ones, worry about the pace of innovation. They said that that's actually, if your pace of innovation is too high, that is actually a negative. And what happens is that you increase the risk chance, because they're all masters of managing risk. And they talk about things like, if you have a black swan event once every 100 years, and that destroys a banking system, which is a thing that used to happen, or maybe less than 100 years, that's something we want to prevent, or at least try to avoid. But if you're doing so much innovation that 100 years shrinks into 50 years, shrinks into 10 years, shrinks into 5 years, that you're doing so much innovation and so much money movement that things are moving so quickly that you have a black swan event every 10 years, that would destroy the economy. And they don't know that's true, but it is. I think it is a legitimate concern by a very risk-averse banker, right? They don't want any of that to happen.
And I guess I have to pick on that a bit. Why? What is the mechanism, or why is that the case? And I say this, maybe I'll play devil's advocate and say that's only the case because of the Jenga block structure of banking that we have, which has a purpose and plays a role, and we all want credit to our local communities and even large businesses. But we have chosen a trade-off that is at risk of a black swan event every X number of years. Is that the right way to think of it, or is there something else that's driving this risk?
I think the argument is that the banking system is slow and heavily regulated, and there's lots of human manual checks around it. And the banking crises we used to have in the 1800s and the early 1900s don't happen in the US anymore. Even a failure like we had in 2008 is a small change compared to, I don't know, the crash in the late 1800s, 1875 or whatever that was. That's there. So you have that. On the other hand, you said, what in the modern world, everything's reconciled to the second. Everything's public. There, you can, if you're smart, you can make smart contracts about like what's allowed to do, what's not allowed to do, and that will not mess up. And I think both of those are legitimate arguments. However, I don't think either of them are exactly right. Like the human regulation is too much and it makes mistakes and can slow innovation. But the software-driven regulation, which is kind of what we're talking about, is a software product. Software has bugs, and there's no way to get around that. And the fact that there can be a system that has a dramatic error is very realistic. And I'll give you one example. Like, let's say there's a bankers in California, where I am, who decide they're going to have their own consortium for stablecoin because they don't want to lose those deposits. And so they get, 100 banks. They have, pick a number, small number, like $10 billion in stablecoin, but it's their own coin. It's not USDC or anything. It's their own coin. Why would anyone want that? Let's pretend they do want that. And all of a sudden, one of those banks crashes because they had another real estate business, and the real estate market in San Francisco failed, and they all of a sudden don't have the deposits they claim to have. What happened to all the people whose money was in stablecoin? Well, that'll have an effect, a domino effect, pull it down. And it's not so much, do I believe ETH has a bug in it? I mean, I'm sure it does, but not really. I mean, I don't really worry about that. Do I believe the interaction with the real world has unintended consequences? I do.
It's like the pragmatic approach of, look, we can be technology optimists as much as we like, but realistically, history has shown that things don't work out that way, and we need to be kind of prepared for that. I agree, and I the pragmatist in me believes that as well. So with all the things that are happening, and we haven't touched on tokenized deposit, but maybe this is a good opportunity to. What should banks be doing now? Like, how should they, wrap all this and think about it and then say, okay, well, it's not actually going to move as quick because we're banks, but the fintechs are going to go fintech. So we do need to pay attention to it. What should the CEO of a community bank or even a regional bank be thinking?
Yeah, tokenized deposits are interesting, but Usually that's a harder concept for them to get around. Like, what are they actually doing there? I think, in my opinion, stablecoin is probably the future. I know the guys at Airbor reasonably well. They're doing it right. I don't know if you can copy them because they're already doing it, but that's the right way to do it. And I think that stablecoin is going to become a new platform to where we can do fintech operations. And I'm waiting for my popularization of stablecoin neobanks. I'm ready. However, most of the community banks don't have that ability. So even though I think it's the future, I think they don't know what to do, and I don't know exactly what to tell them, except they should be part of the conversation. They should do something. And the easiest thing to do is just treat it like another payment rails. It's like international wires. You do that right now. Do stablecoin right now. Like, you can make it very simple, right? Like, do pay in and payouts. Say I only do USDC. If you want to send me money in stablecoin, it's going to end up in a fiat account at the bank. If you want to send money out, I'll send it out and I'll put it in whatever the wallet you want. The end. Like, that is not a hard problem, right? That is pretty straightforward. And you certainly have at least 1% of your customer base who wants to do that, commercial customer base who wants to do that. That's probably more, but 1% is still real. I mean, I think it's more like 10, but let's go with 1%. That's what they should do, in my opinion. They should just be part of the conversation, because then next year they'll have knowledge, and the bank will have a position in how money moves around, and they don't have that today.
That's right. I appreciate that. I think it's very practical, and just this conversation, we've seen that there's a lot of answers that a lot of questions we don't have answers to, and can't have answers to, and we kind of need the market to play out a bit. And so, best thing is to learn, get involved. Then at least you're closer to being in a place where you can iterate towards the next thing. Okay, this is awesome. We're coming up. We are at time here. So really appreciate you coming onto the show. It's really good to hear your insights there. Where can listeners go to learn more about you, Chris, and Treasury Prime?
So treasuryprime.com. It's that's where we are. We are a software company that makes software for banks to help fintechs. And if the fintech needs a bank home, come to us and we'll find you one. If a bank wants more fintech business, come to us and we'll give you some. That's what we do. We're the best one of this group, right? And I think our trick has always been that we try to keep everybody happy, and we don't make any decisions. We hand the fintechs to the banks, we hand the banks to the fintechs, and we bow out.
Awesome. Raj?
Find me on X at rpark and mana.xyz.
And for me, stablecoinblueprint.com and Chuk_XYZ. Thanks, Chris. This was awesome.
Thanks, folks. Good to meet you.
This was a ton of fun. Appreciate it, Chris.
Thanks so much for listening to Money Code. There was so much to take away from today's conversation. I learned a lot, and I hope you did too.
If you enjoyed this episode, do us a favor. Share it with someone you know, or give us a 5-star rating on Apple, Spotify, or wherever you get your podcast from. Until next time.